The very day you walk out of your workplace for the final time, celebrating your freedom and looking forward to decades of hard-earned rest, a silent mechanism triggers inside the Internal Revenue Service. Most Americans believe that when their salary stops, their relationship with the tax collector becomes simpler, quieter, and far less expensive. The reality is the exact opposite. The moment you retire, the IRS completely changes the rules of the game, strips away some of your most powerful financial protections, and takes things from you that you spent your entire adult life taking for granted. If you do not understand exactly what disappears the moment your final paycheck clears, you could find yourself watching your retirement nest egg evaporate into a tax trap you never saw coming. We need to talk openly about this because the tax landscape has fundamentally shifted. With the sunsetting of major tax cuts, we are operating under an entirely new set of rules that heavily penalize the unprepared retiree. For 4 decades, you have played the game of building wealth by one set of rules. You earned income, you took deductions, and you deferred your taxes. But the day you stop working, you enter the distribution phase, and the IRS completely flips the script. Over my years analyzing the tax code and helping people navigate financial transitions, I have seen far too many hardworking individuals get blindsided by penalties and systemic wealth erosion simply because no one warned them that the safety nets they relied on during their working years are legally dismantled the day they retire. Today we are going to walk through the 5 specific assets, rights, and protections the IRS takes away from you the moment you stop working, how these losses compound into a massive financial burden, and exactly what you must do to protect your hard-earned savings before it is too late. Your right to build a tax shelter. The first thing the IRS takes away from you the moment your career ends is one of your most powerful wealth-building tools. Your right to contribute to traditional and Roth IRAs, or employer-sponsored 401k plans. During your working years, you likely took it for granted that as long as you had spare cash, you could shield a portion of it from the government. If you had a great year, you could maximize your contributions, lower your taxable income, and let that money compound safely behind a tax-free wall. The day you stop working, that door is slammed shut. The IRS enforces a strict policy under Internal Revenue Code Section 219. To make a contribution to an individual retirement account, you must have what the government defines as earned income. What earned income is and is not. To understand how dangerous this is, we have to look closely at what the IRS considers valid income for retirement contributions. Earned income. This includes wages, salaries, tips, professional fees, bonuses, and net income from self-employment. Essentially, it is money earned from physical or mental labor performed during that specific tax year. Unearned income. This includes pension payments, Social Security benefits, annuity payouts, interest from bank accounts, dividends from stocks, capital gains from investments, and distributions from existing traditional IRAs or 401ks. Imagine a scenario where you retire and live comfortably on a combination of a $40,000 annual pension, $30,000 in Social Security, and $20,000 in investment dividends. Your total cash flow for the year is $90,000. If the stock market experiences a temporary dip and you want to take $7,000 of your cash to fund a Roth IRA to buy discounted equities for your future, you are legally forbidden from doing so. Despite having $90,000 in perfectly legitimate income flowing into your bank account, your earned income is exactly zero. If you try to make that contribution anyway, thinking no one will notice, you will encounter the IRS's automated matching systems. The government will hit you with an excess contribution penalty, which is a steep 6% excise tax on the contributed amount for every single year the money remains in the account. This creates a highly restrictive financial environment. When you stop working, your ability to actively mitigate your tax burden through standard savings vehicles disappears. You can no longer look at your end-of-year tax projection and say, I need to drop my income by a few $1,000s, so I will just make a quick traditional IRA contribution. The IRS has taken that tool off the table, forcing you to watch your tax liabilities crystallize with very few options for relief. The pre-tax healthcare shield. The second major asset the IRS takes away from you is the structural tax exemption on your healthcare premiums. When you are an employee, your medical insurance is heavily protected by the tax code. Under Section 106 of the Internal Revenue Code, the premiums your employer pays on your behalf are entirely excluded from your gross income. Furthermore, any premium payments deducted from your own paycheck are almost always done on a pre-tax basis through a Section 125 cafeteria plan. This means you do not pay federal income tax, state income tax, or FICA taxes, Social Security and Medicare, on the money used to keep you healthy. The day you stop working, this invisible tax shield vanishes completely. The out-of-pocket tax reality. When you transition into retirement, your healthcare costs typically shift to Medicare or private marketplace insurance. Suddenly, the money required to pay these premiums must be pulled from your own resources. If you take money out of a traditional 401k or traditional IRA to pay your monthly Medicare Part B or Part D premiums, or to pay for a supplemental Medigap policy, every single dollar you withdraw is treated as ordinary income. You have to pay full income taxes just to get the cash necessary to pay for your health care. Let us break down the mathematical impact of losing this pre-tax shield using a standard comparison. Feature working years pre-tax shield, retirement years post-work reality. Source of premium payment, automatic payroll deduction, out-of-pocket distribution. Tax status of dollars used pre-tax, no federal, state, or FICA. Post-tax / fully taxable. Ordinary income effect on adjusted gross income. Lowers your reported AGI, raises your reported AGI. Access to health savings accounts, fully allowed with payroll tax savings, disallowed once enrolled in Medicare. To make matters worse, many retirees think they can simply deduct these massive out-of-pocket medical expenses on their annual tax returns to offset the hit. But the IRS makes this incredibly difficult. To deduct medical expenses in retirement, you must first bypass two steep regulatory hurdles. First, you have to itemize your deductions, which means your total deductions must exceed the standard deduction. Second, you can only deduct medical expenses that exceed 7.5% of your adjusted gross income, AGI. If your AGI is $80,000, the first $6,000 you spend on medical care provides absolutely zero tax benefit. You are paying for those expenses with fully taxed dollars. The IRS effectively forces you to use your costliest retirement funds to pay for healthcare, while simultaneously using those very distributions to push you into a higher tax bracket. Your absolute control over your income. The third asset the IRS takes away from you, though it often lies dormant for a few years after you stop working, is the freedom to choose your own income level. When you are working, you control your earnings based on the hours you clock, the clients you take on, or the salary you negotiate. If you want to keep your income low in a particular year to qualify for certain tax credits or stay within a specific tax bracket, you can choose to work less or defer bonuses. In the early stages of retirement, you might also enjoy drawing precisely what you need from various accounts to manage your tax exposure. But the IRS will not allow you to leave your money in tax-deferred accounts indefinitely. The government wants its cut of the wealth you have spent a lifetime accumulating. The mechanism they use to strip away your control is called the Required Minimum Distribution, RMD framework, the ticking tax bomb of mandatory distributions. Under current law, when you reach the milestone age of 73 and moving to age 75 for individuals who turn 74 after December 31st, 2032, the IRS completely revokes your right to leave your money alone. Every year, the IRS uses a life expectancy table to calculate a specific percentage of your traditional IRA, 401k, 403b, or other tax-deferred accounts that you must withdraw and report as ordinary income. It does not matter if the stock market has crashed and your portfolio is down 20%. It does not matter if you do not need the money because your lifestyle is completely funded by other sources. You are legally compelled to take the distribution. Crucial warning. If you fail to take your required minimum distribution, or if you calculate it incorrectly and take out even $1 less than the mandatory amount, the IRS will hit you with one of the most severe penalties in the entire tax code, a 25% excise tax on the amount that should have been withdrawn but wasn't. While this penalty can be reduced to 10% if corrected quickly, it remains an incredibly harsh financial blow. Consider the reality of a retiree named Robert. He has worked hard, lived frugally, and built a $1.5 million balance in his traditional 401k. He has a modest pension and Social Security that covers all his basic needs. At age 73, his initial RMD factor requires him to withdraw roughly 3.65% of his account balance. That forces nearly $55,000 of fully taxable income directly onto his tax return. This mandatory cash influx can instantly push Robert into a much higher tax bracket, trigger taxes on his Social Security benefits, and artificially inflate his income, causing a cascade of secondary tax penalties across his entire financial plan. The IRS effectively strips away his ability to manage his own income and dictates exactly how much tax he must pay, regardless of his actual financial needs. The tax-exempt guarantee on your Social Security. The fourth asset the IRS takes away from you when you stop working is the tax-free status of your social safety net. When Social Security was originally created, the benefits were completely exempt from federal income taxation. It was viewed as a return of the payroll taxes you paid throughout your career. However, the federal government fundamentally changed the rules, creating a complex, hidden calculation designed to claw back a substantial portion of those benefits from retirees who have any other sources of retirement income. The day you stop working and begin living off your savings, you are forced into the provisional income formula. This calculation determines exactly how much of your Social Security check will be subjected to ordinary income taxes, the provisional income trap. To figure out how much of your benefit the IRS will tax, they calculate your provisional income using a specific formula. The resulting number is then compared against thresholds that have shockingly never been adjusted for inflation since they were implemented in 1984. Because these thresholds remain permanently frozen, normal inflation and modest cost of living adjustments naturally push almost every modern retiree into the tax trap. Married filing jointly thresholds. Under $32,000, 0% taxed. $32,000 to $44,000, up to 50% taxed. Over $44,000, up to 85% taxed. Single filer thresholds. Under $25,000, 0% taxed. $25,000 to $34,000, up to 50% taxed, over $34,000 up to 85% taxed. Let us look at how this plays out for a typical retired couple. Suppose they receive a combined $40,000 a year from Social Security. To cover their basic living expenses, they withdraw $30,000 from their traditional IRA. To find their provisional income, the IRS takes their $30,000 IRA withdrawal and adds half of their Social Security benefits, $20,000. Their provisional income is $50,000. Because $50,000 easily clears the frozen $44,000 threshold for a married couple, up to 85% of their Social Security benefits are now fully subject to ordinary income taxes. This creates a brutal compounding tax effect, often referred to by financial planners as the Social Security tax torpedo. As you withdraw more money from your retirement accounts to outpace inflation, you do not just pay tax on that withdrawn money. Each additional dollar you pull out can expose another 85 cents of your Social Security benefit to taxation, causing your marginal tax rate to spike far higher than what is printed in the official IRS tax tables. Before we reveal the final, most devastating asset the IRS takes away from you, a loss that causes more financial damage to retirees than all the other points combined, we need to address a critical reality. Many people watch presentations like this and assume these tax rules are fixed, distant problems that only affect the ultra-wealthy. That is a dangerous mistake. Under the current tax laws, middle-class retirees face some of the highest effective marginal tax rates in the country due to how these rules overlap and interact. When you stop working, you can no longer afford to be passive. You must shift your mindset from long-term accumulation to highly active tax asset management. The final mechanism we are about to discuss is the ultimate trap, and it is the primary reason why tens of thousands of unsuspecting retirees see their standard of living permanently degraded during their later years: your lower tax bracket status. The fifth and final thing the IRS takes away from you after you stop working is your access to favorable tax brackets and standard deductions. This loss manifests as a devastating double whammy: the widow's tax penalty combined with IRMAA surcharges. When you plan for retirement as a couple, you evaluate your expenses, assets, and tax liabilities based on your status as a married unit filing jointly. You enjoy a large standard deduction and wide forgiving tax brackets. But the statistics are clear. One spouse will almost always outlive the other. The day your household loses a member, the IRS steps in and inflicts a massive tax penalty on the survivor: the widow's tax penalty. When a spouse passes away, the survivor's filing status changes from married filing jointly to single. This shift completely alters their financial landscape. The standard deduction is cut in half. The single standard deduction is exactly half of the married joint deduction. Tax brackets are severely compressed. The income thresholds for single filers are much narrower, meaning it takes far less income to climb into higher tax rates. At the exact same time their deductions are cut and their tax brackets are compressed, the survivor's income rarely drops by half. While one Social Security check will disappear, the smaller of the two, expenses like property taxes, homeowners insurance, utilities, and home maintenance remain exactly the same. If the couple was receiving pension income or generating systematic withdrawals from a shared retirement portfolio, those distributions must continue at nearly the same rate to maintain the survivor's quality of life. As a result, a surviving spouse frequently finds themselves reporting roughly 80% of the household's previous income, but doing so within the highly restrictive single tax framework. This instantly pushes them into a significantly higher tax bracket, causing their tax liability to skyrocket overnight. The IRMAA cliff surcharge. To make matters worse, this compressed income structure directly triggers the Income-Related Monthly Adjustment Amount, or IRMAA. IRMAA is a series of strict statutory cliffs managed by the IRS and Social Security Administration. If a single filer's modified adjusted gross income crosses a specific threshold, the government completely revokes standard Medicare pricing. Standard Medicare Part B premium, instant premium surcharge, up to 300% increase. Because IRMAA is an absolute cliff rather than a progressive tax bracket, going over the limit by a single dollar causes your monthly Medicare premiums to instantly surge across your entire plan. The IRS looks back at your tax returns from 2 years prior to determine your current premium rates. When a spouse passes away, the combination of compressed single brackets, ongoing required minimum distributions, and the loss of the married tax shield forces the survivor over the IRMAA cliffs. The survivor is hit with an aggressive, multi-layered financial blow. Their income tax rates jump significantly, their standard deduction is slashed in half, and their monthly Medicare premiums can easily double or triple. The IRS effectively strips away the stable tax environment you spent decades operating within, leaving the most vulnerable retirees to shoulder a massive financial burden. Summary of the 5 rules. When you step away from your career, the financial rules you lived by for decades are completely dismantled. To protect your retirement, you must keep these 5 key transformations top of mind. Loss of tax shelters. The IRS revokes your right to contribute to traditional or Roth IRAs unless you maintain documented earned income from physical or mental labor. The healthcare tax hit. Your health insurance premiums lose their automatic pre-tax payroll protection, forcing you to pay for care using fully taxed ordinary income. The loss of bracket control. The IRS introduces required minimum distributions, forcing you to take mandatory withdrawals that can artificially inflate your taxable income. Taxation of Social Security. Your benefits lose their tax-free status through the unindexed provisional income formula, exposing up to 85% of your safety net to federal taxes. The single tax penalty. The loss of a spouse forces the survivor into highly compressed single tax brackets and slashes their standard deduction, while simultaneously triggering expensive IRMAA Medicare surcharges. Navigating these shifting rules requires careful planning, foresight, and a willingness to adapt your strategy well before these milestones arrive. I want to hear from you. Have you or someone you care about encountered any of these hidden tax traps after leaving the workforce? Have you run into the complexities of the provisional income calculation or had to navigate the strict rules surrounding earned income? Drop a comment below and share your personal experience or any questions you have about managing taxes during retirement. Let us open up a conversation, support one another, and ensure we keep our hard-earned savings exactly where they belong. Thank you for watching, take care of your financial health, and I will see you in the next video.